Community chat everyone. Today our group gonna talking about stock and bond, and this is our group member. So first I'm gonna talking about stock. So what are stock? One of the most well-known investment option is buying stock. Stock, also referred to as equity, as a type of security that grants you a portion of ownership in a particular business. You can invest in stock and become a shareholder of well-known business like Apple, Tesla, or Intel. By the way, by investing in a stock, you may be able to increase the value of your asset through a capital appreciation, which is an increasing in stock value. In the event that the business pays stockholder a portion of its earnings as dividend, you may also receive dividend. There are two main types of stock. First is common. Common stock signifies company ownership. You have the right to dividend payment and vote at shareholder meeting if you own common stock. And second is preferred. Investors in preferred stock do not have voting privilege but do receive dividend payment ahead of common stockholder. Additionally, preferred stockholders are given preference when a company declares bankruptcy and liquidates its assets. On stock exchange like the Nasdaq or the New York Stock Exchange, stocks are sold although they carry the greatest risk. They also have the greatest potential for growth. It is possible to lose money when investing in stock because stock price can drop significantly in a short period of time. And next is bond. What are the bonds? Bonds are referred to as debt security, while stocks are equity. When a company or organization issues a bond, it assumes that raw borrower and solicits funding from investors to support projects or grow innovative. You are essentially lending money to the issuer. In return, the bond issuer agrees to pay you interest on top of the principal amount. There are several kinds of bonds. First is corporate. Both private and public companies can issue corporate bond. And second, municipal, state, city, and country all issue municipal bond. Next is Treasury. The United States Department of the Treasury issue Treasury bond on behalf of the federal government. They are reasonably safe investment choice because the government backs them. Bond investment can provide you with a steady and predictable income stream in the form of interest payment. There is little risk involved because if you hold onto the bond until its maturity date, you also receive your entire principal back. Bonds are frequently used by investors as a counterbalance to riskier investment options like individual stock in order to hedge against market volatility. You can purchase different types of bonds directly from the government or the government agency through online broker, account, mutual fund, exchange trade fund, or through mutual fund.
What the difference between stock and bonds? The main difference between stock and bond is that stock gives you partial ownership in a corporation, while bonds are a loan from you to the company or government. Another big difference is how they generate profits. Stock might appreciate in value and be sold later on a stock market, while most bonds pay fixed interest over time. Although both stock and bonds are popular investment options, there are several key differences to be aware of before investing your money. For the returns, historically, stocks have a higher return than bonds. According to the U.S. Securities and Exchange Commission or SEC, the stock market has provided an annual returns of about 10% over the long term. By contrast, the typical return for bonds are significantly lower. The average annual return on bonds is about 5%. Thank you.
For the risks, although stocks have greater potential for growth than bonds, they also have much higher levels of risk. With stocks, the prices can rise and fall for a variety of reasons, including factors outside of the company control. For example, supply chain issues and even weather conditions can affect a company production and cause stock prices to plummet. Bonds are relatively safer because they are a debt security. They function as an IOU. The company pays you interest, and once the bond matures, you get your principal back. Bonds aren't completely risk-free. There is the possibility of the issuer defaulting on its bond, or in fact reducing the value of the bond, but compared to stocks, there is less volatility. For the taxes, how the securities are taxed is another major difference between stocks and bonds. With stocks, you pay capital gains taxes when you sell a stock at a profit and on any dividend you receive. Comparing stocks and bonds, although both instruments aim to increase the value of your money, the methods they use and the return they provide are very different. Equity vs debt, bonds and stocks respectively are typically meant when equity and debt markets are discussed. The most widely used liquid financial asset is equity, an investment that can be easily converted into cash. Companies frequently issue equity to raise funds for operation expansion, and in exchange, investors get the chance to profit from the company's future success and growth. When bonds are purchased, a debt is created that must be repaid with interest. Although you won't own any stock in the company, you will sign a contract requiring it or the government to pay a fixed interest rate over time in addition to the principal amount when it is due. Capital gain vs fixed income. Bonds and stock both produce money in unique ways. Selling the company share for more money than you paid for them is the only way to profit from stocks. This is known as a capital gain. The tax treatment of capital gain depends on whether they are long or short term, and whether they are used as income or reinvested. Bonds produce money by regularly paying interest. The frequency of distribution can change, but generally speaking it is as follows. Treasury bond and note, every 6 months until maturity. Treasury bills, early maturity. Corporate bonds, semi-annually, quarterly, monthly, or at maturity. Bonds can be sold on the open market for a capital gain, but for many conservative investors, the fixed income predictability is what makes this instrument so alluring. Similar to how some stock types offer fixed income that resemble debt more so than equity, the value of stocks is typically not derived from this type of income. For inverse performance, the tendency of stock and bonds to have inverse price relationship, whereby when stock price rise, bond prices fall, and vice versa, is another significant distinction between the two. Bond prices have typically fallen on lower demand when stock prices are rising, and more people are buying to benefit from growth. On the other hand, when stock prices decline and investors turn to conventionally lower risk, lower return investment like bonds, their demand rises, and as a result, so do their costs. The performance of bonds and interest rates are closely related. For instance, if interest drops and newly issued bonds have a lower yield than yours, the value of the bond you purchased with a 2% yield may increase. Conversely, higher interest rate might result in newly issued bonds having a higher yield than yours, which would reduce interest in your bond and consequently its value. During economic downturns, when many stocks typically suffer, the Federal Reserve typically lower interest rate to encourage spending. The inverse price dynamic will be extended by the lower interest rate though, which will increase the value of existing bonds.
The risks and rewards of each stock list. The value of your shares declining after you buy them is the biggest risk associated with stock investment. There are a number of factors that affect stock price. You can read more about them in our stock starter guide. In short, a company's stock price may decline if its performance falls short of investor expectation. Stocks are typically riskier than bonds due to a lot of factors that can cause a company's business to decline. 2. There may be a higher return associated with a higher risk. The market average annual return is around 10%, and the Bloomberg Barclays US Aggregate Bond Index measures the US bond market, which has a 10-year total return of 4.76%. Bond risk. In the short term, US Treasury bonds are typically more stable than stock, but as was mentioned above, this lower risk usually results in lower returns. Since the US government backs Treasury securities like government bonds and bills, there are essentially risk-free. Comparatively speaking, the risk and return characteristics of corporate bonds are highly variable. Bonds from a company whose chance of bank is higher than average will be viewed as being much riskier than those from a company whose chance of bank is extremely low. A company credit rating, which is given by credit rating organizations like Moody and Standard & Poor's. Defect is a capacity of repay debt. Corporate bonds can be grouped into two categories: investment grade bond and a high yield bond. Investment grade, higher credit rating, lower risk, lower returns. High yield, lower credit rating, higher risk, higher returns. Building an investment portfolio, also known as deciding how much of each to invest in, involve the various risks and returns. Stock and bond play different roles, and according to Brett Coppell, a certified financial planner in Buffalo, New York, using them in tandem may yield the best results. As a general rule, Coppell asserts investors seeking a higher return should do so by purchasing more equity rather than risk-free income investment. The main functions of fixed income in a portfolio are capital preservation and stock diversification, not maximization of returns.
Okay, for what's a better investment choice, stock or bonds? You must choose the investment strategy that is best for you and your financial objective. Now that you are aware of the difference between stock and bonds, in general, conservative individuals who are close to retirement age should invest in bonds. They have relatively low level of risk and offer consistent, reliable income. Bonds may be a better choice than investing in the stock of market. If you have more time to reach your objective, you have greater growth potential and are better able to withstand market fluctuation if you invest in the stock. If you're still unsure, a target date fund might be something to think about. These funds are all inclusive options that invest in the portfolio of stock and bonds based on your risk tolerance and retirement goals. The target date fund mainly invest in the stock when you are younger, but as you get closer to your desired retirement age, the fund becomes more casual and switches in investment mix to bonds. They are diversified portfolio, making them a viable choice for passive hands-off investor. Yeah, thank you. That's all.